I want you to imagine just for a moment the difference between $1,000 and $10,000, not as numbers, not as commas and zeros, but as choices. $1,000 is a hesitant beginning, tentative, cautious, easily lost, easily wasted, often ignored. $10,000, on the other hand, is possibility. It is momentum. It is the difference between reacting to the market and positioning yourself in front of it. And the route between those two numbers, that 10 times bridge everyone claims to understand, is rarely what it appears to be. People think it's about chasing the next trend, timing the perfect moment, or stumbling into luck disguised as insight. But in my experience, the fastest way to grow a small amount of capital is to stop thinking like a small investor. Because the problem isn't the size of the money, it's the mindset that accompanies it. I want to make this clear right from the beginning. Multiplying capital rapidly is not about finding the hottest sector or the most exciting chart. It rarely comes from instinctive optimism. It comes from identifying mispricing, understanding cycles, and being willing to look at the market the way almost no one else does. You grow 1,000 into 10,000 not by following momentum, but by stepping away from the noise and recognizing that markets reward clarity when everyone else is distracted. This is not motivational language, it's structural truth. Markets move because people misinterpret risk, and they misinterpret risk because they refuse to question assumptions. That's where the opportunity hides. Right now, the market is full of these assumptions. Every cycle has its own mythology, and the present one is no different. People still believe that the easiest profits will come from trends that have already been priced in, or from strategies that worked in the past decade, but operate under completely different conditions today. They cling to the illusion that the market is rational because the alternative, that it is emotional, fragile, and frequently wrong, forces them to rethink everything they believe about risk and reward. But that is precisely where the advantage lies, in understanding that overconfidence always precedes misallocation. If I were sitting in front of a room of new investors today, or speaking into a microphone to an audience watching a documentary-style video on a quiet night, I would tell them that the fastest way to multiply a small amount of capital is to identify where the crowd is blind. Blindness, in the financial sense, is predictable. It happens at extremes: extreme optimism, extreme pessimism, extreme confidence in models, extreme faith in narratives that no longer reflect underlying data. And what I see today is a market depending on assumptions that were never tested under real stress. Liquidity has masked fragility, optimism has disguised structural weaknesses, narratives have replaced reasoning. The average investor says the economy is strong because certain headline numbers suggest resilience, but headline numbers are signals without context. I prefer the context. Wage. Inflation without productivity growth is not strength. Consumer spending on credit is not stability. Markets pricing perfection in sectors that are anything but perfect is not rational. It's complacency wrapped in a thin layer of optimism. When I look at equity valuations in multiple sectors, I see forward projections that rely on best-case outcomes stacked on top of each other like an unstable tower. One wrong assumption, one slightly misplaced forecast, and the whole thing adjusts downward, quickly. So if someone hands me $1,000 and says, "Grow this fast," I don't look for explosive upside. I look for misunderstandings. Mispricing exists when the market is so captivated by one narrative that it ignores another. The most common example today is the assumption that risk-free yields will remain elevated indefinitely without causing structural damage to consumer credit or corporate refinancing. Another example is the belief that index investing removes risk through diversification, even though the largest indices are now more concentrated than at any point in decades. These are blind spots that lead to predictable corrections. To grow capital rapidly, you do not need to predict the future. You need to position yourself correctly for the present mispricing. Small capital has one advantage that large capital envies: mobility. With $1,000, you can enter positions that a billion-dollar fund couldn't touch without moving the price. You can allocate to themes early, before they appear in institutional research reports. You can sit in cash without reporting it to investors who expect constant deployment. You can pivot without committee approval. Small capital is agile capital, and agility is the foundation of leverage. Not financial leverage, but informational leverage. Right now, the fastest opportunities come from areas where the market has overreacted or underreacted. Overreaction usually follows narrative fear. Underreaction usually follows data fatigue. Investors get tired of paying attention, so they ignore new information. If you want to turn $1,000 into $10,000, you find the data nobody else cares about yet. For example, the market often misprices companies or sectors affected by temporary sentiment shocks, even when fundamentals remain intact. Conversely, it underprices companies tied to long-term structural changes simply because those changes develop slower than daily headlines prefer. This is where contrarian analysis becomes useful. Contrarianism is not about disagreeing for the sake of disagreement. It's about recognizing when majority behavior becomes predictably irrational. When the crowd believes something is unquestionably true, the opposite becomes probable. Look at past cycles. When investors universally believed real estate couldn't fall, it collapsed. When they believed tech companies could grow infinitely without revenue, the entire sector revalued. When they assumed money printing would cause immediate runaway inflation, the opposite initially occurred. And when they assumed inflation would remain transitory forever, it surged. Cycles always exaggerate assumptions, and the present moment is full of exaggerated assumptions. What I see now is a peculiar pattern. Investors are simultaneously fearful and complacent. Fearful of volatility, complacent about valuations. Fearful of recession, complacent about consumer debt. Fearful of geopolitical risk, complacent about supply chain fragility. This contradiction creates mispricing, and mispricing is opportunity. If I had to choose the fastest way to compound $1,000, it would be through identifying asymmetric setups. Asymmetry is the art of risking 1 unit of loss to gain 3 or 5 or 10 units of reward. Most investors don't survive long enough to experience asymmetry because they chase symmetric opportunities where gains and losses are roughly equal in probability and magnitude. But asymmetric setups emerge frequently in markets when sentiment diverges from fundamentals. And today's market is full of divergence. Let me give an example without naming specific companies. Imagine a sector that the market has punished excessively due to short-term uncertainty. Prices fall 70%, but earnings decline only 10%. Cash flows remain intact. Balance sheets remain strong. Analysts downgrade the sector not because the fundamentals worsened meaningfully, but because sentiment shifted. That is asymmetry. You risk small because prices have already collapsed and gain large if sentiment normalizes. Conversely, imagine a sector that everyone praises. Earnings rise moderately, but valuations rise dramatically. Prices assume future perfection. That is negative asymmetry. You risk large for a relatively small potential gain because one disappointment can cut valuations in half. Most investors prefer the second scenario because it feels comfortable, but comfort is the enemy of compounding. Small investors with $1,000 should not chase comfort. They should chase mispriced fear. Rapid capital growth does not come from chasing what everyone else is already excited about. It comes from finding the places where the market has clearly overreacted or underreacted, often because investors are distracted by narratives that feel true but aren't supported by data. When I say mispricing, I'm not referring to small discrepancies or minor inefficiencies. I'm talking about situations where sentiment overwhelms logic so completely that price becomes detached from reality. These disconnects don't appear often, but when they do, they offer the kind of asymmetry that allows $1,000 to scale into something meaningfully larger. Most investors never recognize these windows because they're not looking for mispricing. They're looking for confirmation. They want the market to validate their decisions before they make them. But validation is expensive. By the time a trend is obvious, the price already reflects the optimism. By the time the crowd agrees on an idea, the reward has already been extracted. The opportunity goes to the investor willing to act before consensus forms. Mispricing usually emerges at emotional extremes. When the crowd is euphoric, they price assets as if the future will mirror the best moments of the past. When they are fearful, they price assets as if failure is permanent and recovery impossible. Both reactions exaggerate reality. In the euphoric phase, investors ignore risk. In the fearful phase, they ignore potential. This creates pockets where price movements tell a false story. The goal is to understand the real story underneath. This requires a different kind of analysis, not the kind that relies on surface-level indicators, but the kind that examines the underlying mechanics, cash flows, balance sheet strength, competitive positioning, regulatory trends, and where demand is truly headed. When these factors diverge sharply from the prevailing narrative, that's where you find mispricing. An asset that drops 70% does not automatically become mispriced. Sometimes the drop is deserved. Sometimes fundamentals deteriorate beyond repair, but other times the decline is psychological. Investors extrapolate a temporary headwind into a permanent structural decline. They react emotionally to uncertainty rather than analytically to data. If the fundamentals remain intact, and if the assumptions driving the sell-off are exaggerated or unfounded, then the market has created a discount. That discount is where compounding accelerates. The crowd rarely sees this because they are too focused on the trend. They want linear stories, momentum up or momentum down. But markets don't move linearly, they move cyclically. If you expect cycles, you anticipate reversions. And reversion is where mispricing corrects itself, often rapidly. On the opposite extreme, when an asset climbs relentlessly on enthusiasm, investors assume the climb is proof of future strength. They forget that price can rise faster than value. They forget that markets often assign perfection to sectors still full of flaws. When optimism becomes blind, the market misprices risk. That mispricing is harder to exploit directly, but it reveals where capital is crowding, and crowded trades always end the same way, with sharp, unexpected corrections. Avoiding these traps is as important as FI. The undervalued opportunities. Preservation of capital is part of compounding. One large mistake can erase years of intelligent positioning. The real advantage of small capital is that it can move into mispriced pockets before institutions can. Large funds cannot enter small or distressed assets without shifting the price. You can. This agility is a structural edge. It means you can identify mispricing early, act decisively, and exit cleanly once the market catches up. Mispricing is the foundation of rapid compounding because it allows you to buy when others are unwilling and sell when others suddenly become desperate to agree with you. It feels uncomfortable, but discomfort is where returns multiply. Asymmetry is the quiet engine behind every meaningful return I've ever seen, yet most investors overlook it because they're conditioned to think in straight lines. They want a simple equation: risk equals reward. Put in 1 unit of risk, and maybe you get 1 unit of reward. But markets don't operate under simple equations. They operate in cycles, distortions, and emotional overreactions. Asymmetry appears when the potential upside is significantly larger than the downside. Those situations almost always emerge when the crowd is looking the other way. You don't get asymmetry by following momentum or by buying what feels comfortable. You find it in places where the market has already punished an asset so heavily that the remaining downside is naturally limited, while the upside remains unpriced because no one wants to consider a positive outcome. That imbalance between fear and reality is the essence of asymmetry. Most investors misunderstand this. They think a 10 times opportunity comes from explosive growth, from spotting the next breakthrough technology, or catching the next bull market wave. But the truth is less glamorous and far more logical. Tenfold returns usually come from assets priced as if they are on the verge of extinction when in reality, they are merely experiencing temporary difficulty. The market has a habit of catastrophizing. It reacts to short-term pressure as if it defines long-term destiny. When sentiment collapses but fundamentals remain intact, or at least intact enough to justify survival, the price becomes compressed. That compression is where asymmetry hides. You risk little because pessimism has already done most of the damage. But if sentiment eventually normalizes, the return multiple expands rapidly. You're not betting on miracles, you're betting on the market correcting its own exaggerations. The other side of this equation is just as important. Negative asymmetry exists everywhere. It's the trap most retail investors fall into. They see an asset trending upward and assume the trend guarantees safety. They confuse upward momentum with reduced risk, but rising prices narrow the margin for error. Expectations climb faster than fundamentals, and suddenly an asset becomes priced for perfect outcomes, perfect execution, perfect conditions, perfect stability. Perfection is fragile. It doesn't take much to break it. A single earnings miss, a small shift in guidance, a minor regulatory change, or even a change in sentiment can cause a rapid unwinding of inflated valuations. When you buy into perfection, you risk losing far more than you stand to gain. That's what negative asymmetry looks like. Large downside, limited upside, hidden beneath a layer of optimism. The reason asymmetry is so powerful for small investors is that it doesn't require extraordinary predictive ability. It requires discipline, patience, and a willingness to step away from the consensus. When an asset is depressed and unpopular, there is no competition for entry. The crowd doesn't want it. Analysts don't bother with it. It disappears from the spotlight, but this is exactly when price becomes inefficient. Inefficiency is a gift to small capital because it allows you to enter a position before anyone else recognizes the distortion. Once institutional investors or momentum traders eventually return, as they always do once prices begin to recover, the asymmetry shifts in your favor. You entered in the dark, and they arrive only when the light is safe. By then, the multiple is already working for you. But asymmetry doesn't eliminate risk. It reshapes it. It requires you to distinguish between temporary impairment and permanent impairment. Not every distressed asset recovers. The analysis has to be grounded in reality, stable cash flows, manageable debt, competitive moats, or at least credible turnaround conditions. If those elements exist and sentiment is still overwhelmingly negative, then the setup becomes attractive. You're not gambling. You're exploiting emotional mispricing. The risk you take is proportionate, BU. The reward is disproportionate. That's the kind of imbalance that turns $1,000 into $10,000. Not through luck, but through finding opportunities where the math bends in your favor while others fail to notice. Markets don't move on facts alone. They move on the stories people tell themselves about those facts. And when enough people repeat the same story, it becomes a narrative, an emotional shortcut that replaces analysis. Narratives aren't inherently wrong, but they distort reality in predictable ways. They simplify what is complex, exaggerate what is subtle, and ignore what is inconvenient. When you're trying to grow a small amount of capital into something significantly larger, recognizing where these narrative distortions create mispricing is one of the most powerful skills you can develop, because markets rarely misprice fundamentals. They misprice emotions. And emotions, especially collective ones, create opportunities. The problem is that most investors mistake narratives for truth. They hear that a sector is safe, and they accept it without examining the balance sheets. They hear that another sector is dead, and they dismiss it without analyzing the underlying cash flows. Narratives operate like gravity. You don't see them, but they pull everything in a certain direction. When enough money follows the same narrative, price follows that money, not the underlying fundamentals. And when price drifts too far from value, you get distortion. Distortion is where the mispricing begins. What the majority overlooks is how quickly narratives can flip. A sector that is universally praised can be downgraded overnight with a single disappointing data release. A company the market declared irrelevant can suddenly be reevaluated because of a shift in policy, sentiment, or technology adoption. Investors assume narratives are stable, but they are fragile by nature. They depend on confidence, and confidence is one of the most volatile forces in finance. Once it cracks, price follows. This is why relying on narratives is dangerous, but analyzing where narratives distort reality is profitable. Narratives also thrive on selective attention. Investors focus on what is loud, headlines, social media, analyst buzz, and ignore what is quiet, like long-term structural indicators. For example, a sector may be lead declining even though its cash flows are stable, its debt manageable, and its valuation historically cheap. Investors don't look because the narrative tells them not to. This blindness is an advantage to those who do look. When sentiment suppresses price below intrinsic value, a small amount of capital can scale rapidly once the narrative weakens and price snaps back toward reality. Conversely, the market frequently assigns a positive narrative to a sector that is structurally weakening. Investors hear phrases like unstoppable growth, limitless potential, or future-proof industry, and they buy without questioning whether the fundamentals justify that enthusiasm. Narratives inflate valuations far faster than actual performance justifies. This is how bubbles form, not always in the dramatic sense, but in subtle, persistent overpricing that leaves no margin for error. When the story loses appeal, the correction is violent because price was propped up by belief, not data. Those who bought into the narrative suffer the consequences. Those who recognize the disconnect avoid the damage entirely. Mispricing from narratives is amplified by the herd instinct. Once a story becomes widely accepted, few investors are willing to contradict it. Human beings prefer alignment to isolation. In markets, that preference is expensive. The herd is almost always late. They buy after the early movers have already captured the asymmetrical return. They sell only after panic has already driven prices down. Narrative followers don't realize they are pricing emotion, not value. This predictability makes them a source of opportunity for investors willing to detach from crowd psychology. Understanding this dynamic doesn't require cynicism. It requires discipline. You have to question what others accept without examination. You have to separate data from the story built around that data. You have to identify when price moves because investors want a narrative to be true rather than because the fundamentals support it. When you learn to see these distortions, you stop reacting to the market and start anticipating it. Narratives mislead the many, but reward the few who are willing to examine the cracks beneath them. And those cracks, often invisible to most, are where mispricing begins and where small, deliberate investments transform into outsized gains once the narrative inevitably shifts. Majority behavior is predictable, not because people lack intelligence, but because they share the same emotional biases at the same time. Markets create an illusion of rationality, but underneath that illusion is a cycle of fear, greed, denial, and overconfidence that repeats across generations. When enough people share the same belief, whether optimistic or pessimistic, that belief becomes visible in pricing, and price movements driven by collective emotion rather than grounded analysis are the moments when contrarian thinking becomes most valuable. If your goal is to multiply small capital, you cannot afford to behave like the crowd because the crowd always arrives late. They buy when the upside is mostly gone and sell when the downside has already been realized. Predictably irrational behavior creates patterns, and those patterns leave traces. If you're willing to study them, you can position yourself where others refuse to look. What most investors misunderstand is that the majority is not usually wrong because they're stupid. They're wrong because they respond to discomfort. The crowd avoids anything that feels uncertain, volatile, or unpopular. They prefer assets that appear safe, stable, and endorsed by consensus. But safety that depends on everyone agreeing it's safe is one of the most fragile forms of safety. Once the consensus changes, the safety evaporates. This is why assets that look stable because of popularity can collapse faster than assets nobody cares about. When sentiment breaks in a crowded trade, liquidity vanishes instantly. Everyone tries to exit the same door at the same time. The collapse comes not from fundamentals, but from the sudden realization that too many people were betting on the same idea. Contrarian thinking is not about rejecting the majority automatically. It's about recognizing when the majority behaves in a way that predictably distorts price. When optimism becomes uniform and unquestioned, pricing goes beyond reasonable expectations. When pessimism becomes absolute, pricing falls below reasonable valuations. Both extremes present opportunities. The challenge is emotional. Doing the right thing in these moments feels wrong. Buying when everyone else is selling triggers fear. Holding when everyone else is exiting triggers doubt. Waiting while others chase excitement feels like missing out. The discom. Fort is the signal. The majority acts to escape discomfort. The contrarian acts in spite of it. That's why their outcomes differ. Historical cycles repeat because human behavior doesn't change. There have been countless periods when investors dismissed risk simply because prices kept rising. They became comfortable with high valuations because comfort felt like confirmation. Then, inevitably, an external shock exposed how fragile that optimism really was. Conversely, there have been moments when investors dumped assets indiscriminately even when the underlying businesses remained stable. Panic made people sell first and justify later. Those willing to buy during the panic captured the recovery long before the crowd regained confidence. The contrarian approach doesn't require perfect timing. It requires understanding that extremes eventually revert. The biggest advantage a contrarian has is the willingness to question what feels intuitively correct. The majority assumes that recent price movements predict future price movements. If something is going up, they assume it will keep going up. If something is going down, they assume decline will continue indefinitely. This extrapolatio. N error is the engine that powers both bubbles and crashes. Contrarians avoid this trap by focusing on fundamentals rather than recent price action. They ask whether the story the price is telling makes sense, or whether it represents collective emotion masquerading as logic. Being contrarian doesn't mean being right more often. It means being right when it matters. You can be wrong several times on small trades and still outperform dramatically by being correct once on a major mispricing caused by herd psychology. That single instance of stepping in when others step out is enough to multiply capital significantly, but you must be willing to endure periods where the crowd thinks you're wrong, irrational, or early. Early is just another word for alone, and alone is where asymmetric opportunity lives. The majority behaves predictably because they depend on reassurance. Contrarians rely on analysis. One is emotional, the other is rational. And in the long run, markets reward those who can remain rational when others cannot. When people talk about markets, they usually talk about news. They focus on headline events, earnings reports, political noise, or whatever is trending on social platforms. But the longer I study markets, the clearer it becomes that none of those things truly move valuations in a meaningful or lasting way. What determines the direction of asset prices over extended periods is liquidity, how much money is entering the system, how much is leaving, how expensive it is to borrow, and how confident participants feel in deploying capital at scale. Liquidity is the bloodstream of markets, and when it expands, even questionable assets can rise. When it contracts, even the strongest businesses can suffer declines that make no logical sense at first glance. Understanding liquidity cycles is like understanding the seasons. You may not be able to predict the exact temperature on a given day, but you can certainly know either winter is coming or whether you're stepping into early summer. The problem is that most investors focus on short-term narrative spikes rather than structural liquidity shifts. They see a company miss earnings by a few cents and react emotionally. Meanwhile, the broader financial environment tells a completely different story. Perhaps credit conditions are easing, lending activity is rising, consumer spending is holding stable, and central banks are signaling support. In such an environment, temporary weakness in individual names is far less important than the fact that the tide of liquidity is rising. And when that tide rises, it tends to lift far more boats than people expect. Conversely, in a contracting liquidity environment, the fundamentals that everyone cites so confidently begin to lose relevance. Great companies fall alongside mediocre ones, not because of their business performance, but because the market simply cannot support elevated valuations when cash is becoming scarce, expensive, or both. In other words, liquidity dictates the gravity of the market, and gravity always wins. There's a predictable pattern to how investors misinterpret these cycles. When liquidity is tightening, they search for comforting narratives. They convince themselves that innovation, growth stories, or brand strength can defy macroeconomic pressure. They try to rationalize declines by blaming isolated events, not recognizing that shrinking liquidity compresses valuation multiples across the entire market. Prices aren't falling because something is wrong with the business. They're falling because financial conditions no longer support speculative valuation layers. Then, when liquidity begins to ease again, most investors miss the early signals. They are still focused on negative headlines, recession fears, or backward-looking economic data. They fail to notice that the cost of capital is quietly decreasing, risk appetite is creeping back, and money is slowly re-entering the system. By the time the crowd recognizes what is happening, the early gains are already gone. This disconnect between short-term sentiment and long-term liquidity trends is where opportunity forms. If you understand the underlying financial currents, you stop reacting impulsively to news and start anticipating where the market must eventually reprice. Liquidity cycles also explain why certain strategies appear to work brilliantly in one period and fail catastrophically in another. Momentum thrives in high liquidity but collapses under tightening conditions. Deep value shines when liquidity begins to turn upward after a period of contraction. Even the effectiveness of diversification changes depending on where you are in the cycle. The real skill is recognizing these shifts early enough that your positioning benefits from the reversion, long before consensus adjusts. The key is to stop thinking of liquidity as an abstract macroeconomic concept and start treating it as the market's central operating system. Ask simple, structural questions. Is money becoming easier or harder to borrow? Are consumers increasing or cutting back their spending? Are banks tightening or loosening lending standards? Are central banks draining liquidity or injecting it? These questions provide far more predictive value than anything you will hear in a corporate earnings call. They allow you to position capital based on fundamental financial pressures rather than the emotional swings of the crowd. Ultimately, the market doesn't need a reason to move. If the liquidity environment pushes it in a certain direction, prices follow money. Valuations expand and compress based on how abundant or scarce capital feels. If you learn to interpret liquidity cycles with discipline, you begin to see opportunities long before they become obvious. You stop mistaking noise for signal, and you stop treating volatility as a threat rather than a natural byproduct of shifting financial currents. Liquidity is not the most popular topic among investors, but it may be the most important one. Understanding it doesn't guarantee you'll always be right, but ignoring it almost guarantees you'll be wrong when it matters most. Most people obsess over finding the perfect investment, the perfect moment, or the perfect strategy to accelerate their returns. But in practice, the greatest accelerant to wealth isn't extraordinary performance. It's a simple act of staying in the game long enough for compounding to work. What destroys portfolios isn't a lack of opportunity, it's the presence of catastrophic mistakes that wipe out years of progress in a matter of days. The market will always offer the potential for growth, but IT will just as reliably offer traps, illusions, and moments of extreme psychological pressure that push investors into reckless decisions. The difference between building wealth and losing it often comes down to how well you avoid these irreversible errors. The math is unforgiving. Losing half your capital requires a 100% gain just to break even. That asymmetry should force a different mindset, one that treats capital preservation not as a cautious habit, but as a competitive advantage. The irony is that avoiding big mistakes rarely feels exciting in the moment. It often feels like doing nothing while others chase fast returns. It means walking away from what looks like easy money because the underlying risk is too opaque or too asymmetric. Most investors don't like that kind of discomfort. They want movement, activity, affirmation. They want to feel like they're maximizing opportunity. But maximizing opportunity is meaningless if you're also maximizing exposure to hidden downside. The strongest portfolios aren't built by constant action. They're built by a series of intentional, well-calculated decisions paired with the discipline to ignore everything else. That discipline is what T allows compounding to work uninterrupted. Small gains repeated over long periods outperform spectacular wins followed by spectacular losses. The investors who survive are the ones who understand that the slope of the curve matters far less than the continuity of the line. Avoiding catastrophic mistakes requires a certain temperament, skeptical, patient, and willing to re-examine assumptions when data shifts. It's not about pessimism, it's about recognizing that markets reward survival. Every year, countless investors destroy themselves not because they failed to find good ideas, but because they sized their positions too aggressively, chased risk during periods of euphoria, or held on to failing trades out of denial. They assume that conviction is a virtue, when in reality, untested conviction is just ego in disguise. True conviction comes from stress testing a thesis repeatedly, asking what could go wrong, what variables are unknown, what outcomes are being ignored. If the downside is uncertain or unbounded, walking away is not cowardice. It is intelligent risk management. This mindset becomes even more important when dealing with small amounts of capital that you are trying to grow quickly. High reward is attractive, but the higher the reward, the more critical it becomes to control the risk. Small accounts can't absorb large losses. They don't have the cushion to recover. That means your strategy must rely on asymmetry. Opportunities where the downside is limited but the upside is meaningfully larger. People often misunderstand this concept. They think asymmetry means high potential returns. It doesn't. It means favorable imbalance. It means situations where you risk one unit to make many, not situations where you risk many to make one. That distinction determines who survives corrections, recessions, liquidity shocks, and sentiment collapses. Preserving capital also involves understanding when you're wrong. Markets don't reward stubbornness. If the conditions that supported your thesis deteriorate, exiting quickly is not emotional, it's rational. The goal isn't to protect your pride, it's to protect your capital. The longer you cling to a losing position that violates your original assumptions, the more likely it is to metastasize into a catastrophic blow. Every large loss begins as a small one that someone refused to cut. And once the loss grows large enough, the psychology shifts from strategic thinking to desperation. At that point, people don't make decisions, they react. That's how accounts implode. Survival isn't glamorous, but it's the foundation for every extraordinary financial outcome. The investors who compound successfully over decades aren't the ones who take the biggest swings. They're the ones who avoid the fatal ones. They understand that opportunity is infinite, but capital is finite. They recognize that protecting the downside doesn't limit their upside. It enables it. And they accept that consistent discipline is more powerful than intermittent brilliance. Wealth doesn't need heroics. It needs longevity. If you can avoid the mistakes that erase years of progress, the math eventually works in your favor. That's the quiet truth behind every seemingly sudden success story. Before the big wins came the even bigger discipline not to lose everything on the way there.